Hello and welcome. You're tuned into CNBC TV18 Prime. Let's get cracking on a brand new edition of The Big C. I'm Manisha Gupta and with me is Nigel Dsouza, back with your daily dose of commodities, cryptos and currencies. But Nigel, what do we have on our plate today?
Well, we have a couple of big guests who will be joining us. We'll discuss precious metals and the road ahead for prices with Suki of Standard Chartered. We'll also discuss crude and how the macros are shaping up. Osama Rizvi of Primary Vision will be joining in as well. But before we get to that, let's do a quick read-through of the global markets. Wall Street logged a winning session following that dramatic reversal from US President Donald Trump, who claimed he was not planning to fire the Fed Chair Powell. Stock futures, however, a little bit lackluster as we speak. Stocks in Asia Pacific, by the way, they're largely trading in the green as investors assess the fall in Japanese exports for the second consecutive month. Well, back home, the Nifty, it still continues to trade in that band. It's come off a little bit from the lows. The good news is it holds on to the 25,100 odd mark. Last couple of hours will be quite volatile today because of expiry.
Well, that's about the equity markets, but take a look at the crude oil prices now. And the economic data from the world's top oil consumers is keeping the prices afloat amid signs of easing trade tensions. But in the last 1 month, when you look at the crude oil prices, they have declined 10%. The U.S. crude inventories fell by 3.9 million barrels to around 422.2 million barrels in the U.S. last week. A steeper decline than forecast for a 552,000 barrels draw suggests a stronger refinery activity and a tighter supply. It also is talking about increased demand. Remember, it's the driving season in U.S. and that is keeping the prices supportive. Meanwhile, the dollar index tumbled briefly but pared those losses soon enough, especially after the U.S. President Trump denied plans to fire Jerome Powell from the post of chairman of the Federal Reserve. And that clearly is keeping the markets very, very jittery right now. But let's talk about the crude oil prices. And we're joined by Osama Rizvi. He's energy and economic analyst at Primary Vision. Osama, hi, thank you so much for joining in. It has been a very, very volatile crude oil prices. But the fun is that it is keeping in that very steady range, with markets talking about 60, even 80 for that matter. It's a huge range. Of course, it's a case-based scenario on what happens, and that's how the crude prices will move. My first question to you is about the crude prices itself. What is it that you're watching, and what's your sense on the crude prices for the rest of this year?
Well, thank you so much for having me today. I think the question you ask is very interesting, and it has two sides to it. You know, when we look at the physical barrels, there is a different story. There is different estimate. When we look at what are called the paper barrels, the price estimates also turns out to vary across. When we look at the physical barrels, let's look what's happening. We saw that OPEC Plus produced 830,000 barrels per day above their production quota. This was also more than the 548,000 barrels per day they said they're going to produce. And out of this, 600,000 barrels came from Saudi Arabia. And we are also seeing that these are not just production ceilings, but when we look at the exports, for instance, look at China. The recent allocation for China from Saudi Arabia are at its highest point since 2023. Now, China is also importing a lot of oil. But does it mean that this is driven by demand? I don't think so. And that is why I believe when we look at the physical crude prices, physical crude markets, I believe there is more supply than demand. We will talk about the macroeconomic indicators, but very quickly, our market sentiment tracker from the previous few weeks have been bearish on EU, have been bearish on US, slightly bullish on China. So I don't see any demand, actual demand supporting all of these barrels. Hence, I expect prices even to fall further into the lower 60s. And of course, the chances of prices going below 60 is more than chances of prices hitting 80. So I'm expecting a tight range-bound market with maximum ceiling at 75.
Interesting, Osama. Well, that's, clearly concerned with regard to demand. As you said, supply is outweighing demand, at least as of now. But let's briefly talk about the macros. Various data points from the globe, as you mentioned, have been a little bit softish. While China, you're saying maybe, in fact, there is mixed data coming out of there. Let's talk about the U.S. data first. We've got the inflation prints that have come in the last couple of days, both CPI as well as PPI. What is your reading of that, the impact on the Fed's decision as well? And in turn, what about the US dollar?
Well, when we look at the US, There are certain indicators that are short-term that concerns or correspond to the financial side of the economy. But when we look at the real economy, we talk about ISM manufacturing index. It's still at 49, still in the contractionary territory. When we look at the consumer side, I think we discussed this last time as well. The consumers are still not holding very well. Also, the risks of tariffs, although the tariffs have been quote unquote rationalized, still tariffs, the effective tariff rate is higher. I don't know, highest in the last 100 years or something. And this has started to show up. Walmart and other retailers have increased its prices. When we look at the sale to inventory ratio, it has also gone up. When we look at the amount of indebtedness, of course, that has also gone up. And the US debt prices is sort of chipping away the confidence in the economy and the dollar. And we have to look at the bond markets as well. Interestingly, we have a precedent what is happening in the Japanese bond market. It's a very important indicator to look at. So I think the US is giving mixed signals, but mainly according to me, for instance, when we look at the Conference Board Leading Index, 30% of the people expect unemployment to go down in the next 6 months. And this has been a consistent indicator in the previous recession that anytime this figure has gone above 30, a recession has followed. Now, I'm not saying that there will be a recession in the technical definition of it, but there will be a slowdown. I'm expecting that because the overall ingredients are as such that it will lead to this outcome.
Osama, I'm just fishing for some numbers here. When you look at crude oil demand growth, what is your sense? We do understand that India perhaps is one of the most, the highest in sense of demand growth here. How would you look at China? Because everything that comes out of China does impact crude oil prices. So when you look at these numbers across world, one, what is your global demand growth expectation for this year? How would you fit in China and India there?
Well, I would agree with the recent reports produced by various organizations. I think we can look at a global demand growth of somewhere around 800,000 barrels to 900,000 barrels per day, but definitely less than 1 million. Because I say that because I also expect the supply overhang to be more than 1.1 or 1.2 million barrels for the rest of the year and in 2026 as well. Speaking about China specifically, China's case is very interesting. First, we need to realize that China has become a very price-sensitive buyer. Now, given the fact China has recently, in June, imported 12.19 million barrels of oil per day. The refining rate is at its highest point. They're processing 15 million barrels per day. But this is not demand. They are building their inventories that already stand at 1 billion barrels. So I expect Chinese figures to slow down as well. I expect them to slow down to somewhere around 11 or 10.5 million barrels per day as we move into the second half of 2025.
Osama, just wanting to get that India number as well, Osama.
India's demand growth has been one of the strongest, as you said. And moving forward, I expect it to stay there or maybe inch up a little bit. But definitely, we need to look at one side. Refined products market is tightening. And I think as we move forward, and if this continues to happen, that can have an impact on oil prices. If they inch up, India's demand growth can come down, but it will definitely be, where it is right now. I don't see a high downfall or a rationalization in this regard.
Osama, the biggest nervous sentiment that we saw last night was because of Trump supposedly wanting Powell out. He's been going at him that he's not cutting rates enough and, the rates should be much lower and the likes. That's been going on for a while. But now the fear is that there's going to be a knockout punch. Unsure whether or not legally that can be done. But what is your take? That was the fear out there. He's clarified for now that's not his intention unless there is a fraud or something on those lines. If in case, that does take place, well, that would send the dollar in a spiral, maybe the equity markets as well in a spiral. Your reading?
Well, Nigel, this is Trump's love and hate relationship with the Fed is not, new. It's a well-founded, established fact. And what Powell wants, Trump wants the exact opposite of it. And being economists or analysts, we all know that we can't look for 1% or less than 2% of interest rates at this moment. Even though we have seen some downfall in inflation, it still has proven to be sticky. And with the direct threat, as we just discussed, it's too early to cut rates. Given this to and fro between Powell and Trump, I don't think, and also the conditions at home, what's happening across the world, various engagements, geopolitical and diplomatic, I don't think Trump administration would take this step. And I don't also think that this will be legal, and this would, of course, be held in the court or the Congress. But this is a far-fetched idea. If that is to happen, that would certainly wreak havoc with the U.S. markets, and the bond yields are not that low as well. They can easily surge beyond 5%, further deteriorating the dollar index. So I expect the administration to be wise enough not to take this step.
Osama, I also want to deviate from crude to crude products. When you look at natural gas, we are looking at strong demand. It's air conditioning season. When you look at US, Canada, and the rest of that world there, heating oil prices have been volatile. The gasoline prices slightly under pressure at this point in time. So when you look at the crude products, what's your sense?
Well, interestingly, last week and a few days ago, when we looked at the product side of the crude markets, there was a tightening. When we looked at the ARA stocks, they were at their lowest point in the last 17 months. In the US as well, commercial, of course, inventories fell. But today, or last night, we have seen a strange uptick in distillate stockpiles, heating fuel and diesel, despite the fact that we're in the summer driving season, and despite the fact that refineries are operating at 93-94% throughput rate. This increase in stockpiles is concerning and speak about the fact that the summer driving demand has not been up to the mark. First. Secondly, if you look in Europe, once again, the energy-intensive manufacturing in Europe has been in decline since 2 years. It still remains that. We look at latest figures coming out of Germany, coming out of Italy's industrial production. Both are down. Last week, they were both down. So I think we have to wait and watch. This, in the product stockpiles, there was a trend of tightening, but it seems to be dissipating. If this continues, it will further put down the pressure and also corroborate this thesis that the supply overhang is here to stay.
All right. I wanted a couple of more levels, if you could help us out with that, Osama. The dollar index, well, it went down to around the 96.3 odd mark. Not sure whether or not you have a level out there, but it's popped up to around 98. And now some on the street believe that maybe, in fact, the worst has been seen in terms of this dollar decline for the current, the current fall. What is your view? Do you expect the dollar index to regain some part of the lost ground?
Well, I would like to say, while I don't consider myself as an expert on the dollar index, but I would like to say that this isn't certainly the floor. I would like to quote Ray Dalio here, because he has been really highlighting what's happening with the US big debt cycle. And I think we need to pay more attention to it, specifically after the big, beautiful budget, the big, beautiful bill was passed. It is going to create lots of further deficit. US cannot afford that at this point. When we look at the other side of the pond, BRICS currencies, a BRICS mechanism, BRICS coalescing together, they are also gaining traction. So the usage of dollar, or the level of foreign exchange reserves being held in dollar, it's still at 58%. But even a further 1% fall can impact the confidence in the currency. So it can easily touch 97 or 96 as well. But definitely, I don't see it falling. I don't see it tracing its high back to above 100 levels. Not this year, not in 2026.
All right. Well, interestingly, Nigel, all the people that we've been talking to on the show have been giving us a very, very wide range, haven't they?
Yes.
From 102 to 98, even 87 for that matter.
Yeah, 87.
Yeah.
87.
So, so Osama, that's of course anybody's guess, but we do understand your point there. There's just so much happening right now, and what way the tides will go is anybody's guess. But thank you so much for joining us on the show today with your sense on economics, dollar index, and of course the crude oil prices. But with that, it's time for a short breather on the show. Up next, we'll extend the discussion with Suki Cooper of Standard Chartered and talk all things precious metals. Welcome back. We're now joined by Suki Cooper of Standard Chartered. Suki, hi, thank you so much for joining in. And gold is on my list first. It has been one of the best performing asset classes in the first half of this year. The second half also has started on a very strong consolidated footing. Would you believe the upside continuing in case of gold in the second half as well? Because most of the factors that we were dealing with in the first half is what we've seen second half begin with as well.
We still see further upside risk for the gold market. We think that we'll see prices hitting fresh record highs before the year is out. There are a number of factors that have really supported this rally, and we don't think any of them have faded just yet. The critical factor really has been the central bank buying, and yes, volumes have slowed down from the elevated levels they were at last year, but they're still strong despite the record prices. In addition to this, we're still continuing to see strong investor appetite across the board. And it's not just one factor that's driving a lot of that investor appetite. It ranges from safe haven demand to concerns around debt levels to concerns that we'll continue to see heightened uncertainty. And many of these factors are continuing to lend itself to further interest in gold.
All right, Suki, good to have you on the show. Thanks a lot for joining in. Let's talk about gold, because all that glitters has been gold. The question is, what's the price outlook from here on? Tell us your view.
We could see prices averaging 3,700 before the year is out, but we think going into the middle of 2026, that's when we'll see gold prices gaining further momentum and reaching $4,000 per ounce at that point. We think that there's still a number of factors, a number of tailwinds that are continuing to support the appetite in gold. So we do think fresh record highs are still in the offing for the market.
So, Suki, when you talk about price levels of $3,700 and $4,000 an ounce, where do you see support coming in? Is it going to be about weak US dollar or geopolitical tensions or a very strong investor demand that you're anticipating? Or is it going to be about central bank buying yet again?
I'd say there are a few key factors that we need to keep an eye on. Firstly, there are potentially headwinds that could derail gold rally in the short term, and we really need to keep an eye on those on a longer term basis. Gold prices tend to outperform when we see strong investor demand, but also when there's a strong physical floor limiting that downside risk. For now, a lot of that demand has come from central bank buying, but India and China continue to be core markets. So far this year, the demand in India has weakened under gold prices reaching 100,000 rupees per 10 grams. That's record levels, and that's really pressured a lot of the local interest in the gold market. It's seen imports starting to slow as well. So the fact that one of the key markets has seen a weaker appetite amid higher prices is an area for caution. Then the second factor here is really around China's demand. And in contrast, we've seen China's market trading at a sustained premium, whereas India's market is traded at a discount. And China's market has continued to grow at a rapid pace on both the jewelry side and the investor appetite. And to some extent, this has offset the weakness that we've seen elsewhere. But if we start to see physical demand weakening from both China and India, then that exposes gold prices to downside risk. We're also entering a seasonally slow period for consumption in the coming weeks, and we expect demand to pick up when we enter the festival-related buying or wedding-related buying later in the third quarter. But for now, we're entering a particularly fragile period when it comes to physical market. So the physical market continues to be a key area to watch. And then on top of that, central bank buying has been a crucial driver for this gold market since 2022. If that appetite starts to slow down as well, that's another element that would need to be plugged by interest elsewhere. The third factor that we'd really keep an eye on is ETF buying. When gold prices really started to gain momentum in 2023, 2024, ETF demand was largely absent. But that has changed in the early part of 2025. And this appetite tends to follow much more broader factors to drive that demand higher. So if ETF flows turn negative and remain negative, that's another gap that will need to be filled by demand elsewhere. So I'd say these are the three areas that we really need to keep an eye on in the coming weeks.
Well, so let's take that point a little ahead then. The ETF demand and the CFTC data doesn't show very strong net longs for gold. What is your view?
When we look at this rally, it's really been driven by a lot of the physical flows. So that tactical positioning tends to suggest certainly positive sentiment towards the gold market, but it also tends to suggest short term, more fleeting appetite in the gold space. So, if this rally had been only driven by a strong build in futures positioning, that would have been more of a warning flag in terms of gold market upward momentum. But the fact that positioning has remained steady at firmly net long positions, but it hasn't grown rapidly, suggests that there are other factors that have really driven this gold market higher, and it's not dependent on some of that short-term tactical positioning in the gold space. So on the one hand, it remains positive that we're not close to peak levels. If we One of the measures that we'd like to look at is futures positioning as a percentage of open interest, and that's around about 30%. But at its peak, it was around about 47%. So this suggests to us that there's further upside risk that could be built on the back of tactical positioning growing. So we believe it's actually a positive for the gold market, the fact that this positioning isn't overcrowded and it's not stretched.
All right, that's interesting to know then. But I also want to talk about the gold silver ratio because that clearly has been talk of the town. We were at 100 plus, and then from there we've come to 85, 87 kind of levels. Markets do believe that 70 is an average to watch out for. Does that mean that silver has more upside from here, the way the averages seem to be moving?
It tends to be a factor that some investors like to look at. And when we tend to see the ratio elevated, it tends to be an indicator that potentially silver is undervalued. But one of the things that we would highlight here is that there's been very different drivers behind both the gold rally and now the more recent silver rally. Gold has really benefited from the central bank flows, from the demand for flight to safety, whereas silver has largely and structurally been an industrial story rather than an investment story. So the silver market, we've seen it undersupplied for the past 3 years and quite a deep deficit, but that hasn't necessarily translated into higher prices. But that has started to change as this year has unfolded. But what has been key for the silver market is the growth in terms of photovoltaic demand, the solar demand, but also in terms of electrification of vehicles and that continued robust appetite in terms of industrial demand, really pushing that floor higher for the silver market. When silver tends to outperform is when we see both investment demand and industrial demand pushing prices higher. And now we're starting to see strong silver ETP inflows that have helped to buoy prices as well. So that suggests that there's more upside risk for the silver market, but the dynamics behind the gold rally and silver have been very different.
You want to quantify that? What is the silver price outlook, say, in the near term? Or if you want to give us, say, in the next 12 months or so?
We do see upside risk for the silver market, not necessarily to the same extent that we see gold upside risk. We had forecast silver prices to average $37 per ounce in the fourth quarter of this year, and we're already trading at those sort of levels now. We believe that the silver rally has got ahead of itself, and we've started to see more upside risk unfolding very, very quickly. There's some uncertainty around tariffs and some demand some demand that could be fragile in the near term. We think that we might see some of the sentiment softening in the silver space if we continue to see prices elevated. It might expose some of the silver consumption to substitution in the nearer term. But overall, we still see a market that's going to be undersupplied, and we still think that prices could reach that $40 per ounce. But potentially, we see that unfolding over a longer period of time, and any spikes in the near term might be more short-lived.
All right, so that's interesting. But also, have you seen the platinum prices? Because the last quarter clearly belonged to platinum with those 30–40% kind of gains. Has platinum now baked in all the stronger fundamentals in sense of deficit in sense of supplies there? Or are you looking at further run up from these levels?
There's so many different factors that have unfolded for the platinum space all at the same time, both on the supply side and in terms of demand picture. We know from earlier this year that the flooding in South Africa meant that the first quarter production was lower than we typically tend to see. We tend to see a slowdown in PGM output at the start of the year due to care and maintenance, also maintenance work that tends to be carried out. But that set up the platinum market to be a lot tighter than what had been anticipated for this year. We are expecting a market to be undersupplied, but that shortfall on the supply side has just tightened the market a little bit faster. And then compounding this supply side has been the developments that we've seen in terms of platinum jewelry consumption. at least at this stage, at the wholesale level, there's been an uptick in appetite, potentially substituting white gold for platinum pieces instead. And that's meant that in the near term, imports into China have been very, very strong. And we've seen that there's been an increase in stocks potentially in China, but that's also meant that there's less available supply in terms of above ground inventory on a global basis. So when we see these periods of tightness, it's meant that platinum prices have been exposed to the upside to much more extreme levels than we've seen in the past. In the past, we've had markets that have been in deficit, but we had plentiful inventory able to meet that shortfall. That has started to shift now as there's less inventory to cover some of that shortfall, which means that platinum prices are likely to be exposed to the upside over the next couple of years.
All right, so the next couple of years as well could be looking at platinum prices on the positive side there. Suki, for all the conversation that we've had with you, you've been bullish gold and silver and platinum as well. If you had to include this in your portfolio, and because every metal has different fundamentals, how would you really stack them in sense of an order of 1, 2, 3 perhaps?
If we were looking at a horizon over the next year or so, we'd say gold has the most upside risk. But if we're looking at a longer term period, say the next 3 to 4 years, then we'd say platinum has the more upside risk potential.
You talked about gold and platinum and not silver, Suki.
We like silver. We think that there's more, it is likely to be exposed to more upward momentum. But relatively, in terms of percentage gains, we think that gold over a 1 year time horizon has more upside potential. And then on a longer term, we think that the platinum market is likely to remain quite tight. Silver, we think that we're going to see quite volatile price action. If investment demand can meet some of that shortfall that we see in terms of demand growth, then we could see more volatile prices rather than a sustained upward move in silver.
All right, golden words those. And Suki, thank you so much for joining in. So that's what's coming in from Standard Chartered. Gold, a definite buy. Platinum is the second one on their list. Third is silver, because silver is going to be very volatile. And whether or not it gives you much more upside from here is the view coming in from the bank there. Thank you so much for your time here. And with that, that's all the time that we have on this episode of Big C. A big thank you from me and Nigel for watching and the entire team that put this show together.